Silver just experienced something the textbook said was impossible, a metal that touched triple digits, collapsed by margins that erased months of gains and hours, while physical dealers couldn't keep inventory on shelves at any price. Two markets, same asset. Completely opposite realities. Wall Street saw capitulation, Main Street saw scarcity, and somewhere between the screen price and the transaction price, the truth about what's really happening in precious metals got buried under panic. But here's what almost nobody is telling you. This wasn't the end of anything. It was the beginning of something far more significant. And if you don't understand the difference between a structural collapse and a structural reset, what happens next is going to catch you completely unprepared. Welcome to Financial Crisis Explained. Now, I know you've been through enough market cycles to recognize when something doesn't add up. So let me ask you this, the way I'd ask a seasoned professional. If this analysis makes sense to you, if you value clarity over noise in times like these, do me a favor and subscribe to this channel, not because I'm asking, but because the next few months are going to separate those who understand market structure from those who just react to headlines. And before we go further, drop a comment below telling me where you're watching this from. New York, London, Singapore, Mumbai, because what's happening in silver right now, it's global. And I want to know where the people who actually understand this are paying attention from. Now, let's get into what really happened. February 2025 marked a moment in financial markets that defied conventional analysis. Silver, the metal that has alternated between monetary relic and industrial commodity for centuries, achieved something remarkable. It broke into triple-digit territory. For context, this wasn't a gradual climb. This was a vertical assault on price levels that analysts had projected might take years to reach. Gold had already breached the psychological barrier of $5,000 per ounce, a move that sent ripples through central bank boardrooms and treasury departments globally. But silver's ascent was different in character. It was faster, more violent, and carried the unmistakable signature of something beyond normal bull market behavior. In the span of weeks, silver transformed from a precious metal investment into what traders call a momentum asset, the kind of price action typically reserved for speculative technology stocks or cryptocurrency during euphoric phases. Not a 5,000-year-old store of value. The futures markets showed positioning that hadn't been seen in decades. Speculative long positions reached historical extremes. Open interest expanded to levels that suggested not just optimism, but conviction bordering on certainty. And then, the floor disappeared. What happened next wasn't a correction in the traditional sense. It was a rupture. In a single trading session, silver didn't retreat. It collapsed. Double-digit percentage declines that erased weeks of gains and hours, volume that exceeded anything seen during the rally phase, and perhaps, most tellingly, a divergence between what screens displayed and what actual transactions could achieve that revealed something fundamentally broken in market structure. Traders who attempted to exit positions found slippage that turned calculated exits into catastrophic losses. Stop-loss orders that should have provided protection instead executed at prices that defied logic. And, across trading desks from Chicago to London to Singapore, the same question emerged. What just happened? The initial explanations came fast, too fast to be credible. Some declared the silver bull market dead, proof that the rally had been nothing more than speculative excess meeting inevitable reality. Others claimed the opposite, that the violent sell-off was clear evidence of market manipulation, a coordinated attack by institutional powers threatened by silver's rise, and that the next move would be even more explosive to the upside. Both narratives had the advantage of simplicity. Both offered clean, emotionally satisfying stories, and both missed the actual mechanism that created the chaos, because what made this event genuinely significant wasn't the size of the decline. Precious metals have experienced violent corrections before. What made it significant was the divergence. While paper silver, the futures contracts, the exchange-traded funds, the derivative instruments collapsed, physical silver markets told a completely different story. Dealers reported premiums expanding, not contracting, delivery delays extending, not shortening, and buyer interest intensifying, not evaporating. In some markets, the spread between the screen price and the actual transaction price for physical metal reached levels not seen since the acute phase of the 2020 pandemic crisis, when fear drove populations toward tangible assets and away from financial abstractions. This created a paradox that traditional market analysis struggles to explain. How can an asset be in free fall and shortage simultaneously? How can price discovery in futures markets diverge so dramatically from price discovery in physical markets? And most importantly, for anyone attempting to understand what comes next, which price is telling the truth? The conventional framework suggests these markets should converge, that arbitrage mechanisms should eliminate meaningful gaps between paper and physical pricing. that liquidity providers should step in when dislocations create opportunity. But that framework assumes normal market conditions. In February 2025 demonstrated conclusively that conditions were anything but normal. What transpired wasn't simply a large down day in a volatile asset. It was a stress test of the entire precious metals market infrastructure. A test that revealed fractures in the relationship between financial instruments and the physical commodities they theoretically represent, and a moment that forced serious market participants to confront an uncomfortable question. If the price on the screen isn't the price you can actually transact at, if liquidity evaporates precisely when you need it most, if the instruments designed to provide exposure to an asset can move independently of the asset itself, then what exactly are you invested in? The answer to that question determines everything that follows, because the difference between a market experiencing a terminal collapse and a market undergoing a structural transformation lies entirely in understanding what happened beneath the surface of that violent sell-off, and why the physical market didn't just fail to collapse, it tightened. There's a difference between a market that's falling and a market that's breaking. And what happened to silver in February 2025 was the latter. To understand why requires looking past the price charts, past the headlines, and into the actual machinery of how modern precious metals markets function when stress enters the system. Because the violence of the sell-off wasn't the story. The story was what the violence revealed about the infrastructure itself. Start with a fundamental reality that most market participants never consider. The silver market isn't actually one market. It's multiple markets operating under the same name, with different participants, different constraints, and critically, different definitions of what silver actually means. In the futures markets, silver is a contract, a legally binding agreement to deliver or accept delivery of metal at a specified price and date. But here's what the textbooks don't emphasize. The overwhelming majority of these contracts never result in actual delivery. They're cash settled, closed out before expiration, traded purely as price exposure instruments with no intention of ever touching physical metal. This creates a mathematical reality that becomes dangerous under stress. The notional value of silver represented in futures contracts vastly exceeds the physical metal available for delivery by orders of magnitude. Under normal conditions, this doesn't matter, because under normal conditions, only a tiny percentage of contract holders ever demand delivery. The system functions on the assumption that most participants want price exposure, not metal. But February 2025 wasn't normal conditions. As silver accelerated upward, something shifted in participant behavior. Margin requirements increased. Leverage that had amplified gains on the way up began amplifying risk on any potential reversal. And positioning had become so one-sided that the market had become structurally fragile. Then the selling began. What started as profit-taking transformed into something more systemic. Because in leveraged futures markets, price declines trigger margin calls. Margin calls force liquidations, and forced liquidations create more price declines, a feedback loop that doesn't stop at rational support levels. It stops when there are no more forced sellers left. But here's where the real breakdown occurred. The liquidity that participants assumed would be there wasn't. Market makers who normally provide continuous bid-offer spreads widened those spreads to levels that made transactions nearly impossible. Electronic trading algorithms that normally smooth price discovery instead pulled back entirely when volatility exceeded programmed thresholds. And the depth of the order book, the cushion of buy orders that should absorb selling pressure, evaporated. What this meant in practical terms was brutal. A trader attempting to exit a position might see a price of $90 on the screen, but the actual execution might occur at 87 or 84, or in extreme cases, even lower. The screen price became a fiction. A number that represented where the last transaction occurred, not where the next transaction could occur. This is what professionals mean when they talk about liquidity crisis. Not that no transactions happen, but that transactions happen at prices disconnected from displayed quotes, and that the cost of immediacy, the cost of exiting right now, becomes prohibitive. Now layer in the dealer dynamics, the commercial entities that hold short positions as hedges against physical inventory. Under normal circumstances, these shorts represent legitimate business hedging. A dealer who owns physical silver sells futures contracts to lock in profit margins, but when prices move vertically, even legitimate hedges can require additional margin. And if those hedges are suddenly profitable because prices are collapsing, the temptation to reduce hedge positions accelerates the downward momentum. The data from the Commitment of Traders reports told a clear story. Speculative longs had reached extremes, commercial shorts had reached corresponding extremes, and the imbalance created a powder keg waiting for ignition. What's crucial to understand is that this mechanism doesn't require conspiracy. It doesn't require manipulation in the conventional sense. It simply requires a market structure where leverage amplifies moves, where liquidity is conditional rather than guaranteed, and where the assumption of continuous price discovery breaks down under volume stress. But here's what made February 2025 genuinely unprecedented. While the futures markets were experiencing this liquidity crisis, while paper silver was in free fall, while derivatives and ETFs were seeing a panic liquidation, the physical market was doing something entirely different. Retail dealers reported that customer buying intensified during the sell-off. Wholesale premiums, the markup above spot price for actual metal delivery, expanded rather than contracted. Refineries and mints reported order backlogs extending. And most tellingly, delivery times for physical silver lengthened even as the paper price suggested abundant supply. This created a surreal situation. Two markets, same asset, opposite signals. One market screaming oversupply and capitulation, another market demonstrating scarcity and persistent demand. And somewhere in that gap between paper price and physical availability lay the truth about what was actually happening. Not to silver the financial instrument, but to silver the physical commodity. Because if the sell-off was truly driven by fundamental oversupply, if demand had genuinely collapsed, then physical premiums should have compressed, delivery times should have shortened, and dealers should have been eager to reduce inventory at any price. None of that happened, which meant the violence in paper markets was revealing something else entirely. Not the end of a bull market, but a fracture in the infrastructure connecting paper claims to physical reality, a fracture that was about to become impossible to ignore. While screens around the world displayed carnage, a quieter transaction was telling a completely different story. In Melbourne, a bullion dealer received more purchase orders in 72 hours than the previous month combined. In Frankfurt, wholesale distributors reported allocation delays extending from days into weeks. In Singapore, premiums over spot price reached levels typically reserved for supply disruptions caused by refinery shutdowns or transportation crises. Except there was no refinery shutdown, no transportation crisis, just a paper price collapse that should have, by every conventional measure, made physical metal easier to obtain, not harder. This wasn't anecdotal noise. This was systematic divergence across geographic markets and product categories, and it pointed to something the futures sell-off completely obscured. The physical silver market wasn't reacting to price decline, it was reacting to opportunity. Consider the mechanics of what buyers were actually seeing. A metal that had touched triple digits now suddenly available at 30% discounts to recent highs. With fundamental demand drivers, solar panel manufacturing, electrical infrastructure, industrial applications, showing no signs of weakening, and with long-term supply constraints still firmly in place despite short-term price action. For entities that measure value in years rather than hours, the sell-off wasn't a warning signal, it was a purchase window. The premium data made this explicit. In normal markets, when spot prices fall sharply, premiums compress. Dealers become eager to move inventory before further declines. Buyers wait for confirmation of a bottom before committing capital. Supply exceeds demand, and the spread between paper price and physical transaction price narrows. February 2025 demonstrated the opposite pattern. 1-ounce retail coins that typically traded at 3 to 5% above spot were commanding 8 to 12% premiums. Wholesale bars in 1,000-ounce form, normally the most liquid physical product with minimal premiums, were showing spreads of 4 to 6%. And certain product categories, particularly smaller denominations suitable for retail investors, effectively became unavailable at any premium. Dealers couldn't source inventory fast enough to meet incoming orders. Now, consider what this means from a market structure perspective. The futures market was pricing in capitulation. Positioning data showed speculative longs exiting en masse. Technical analysts declared key support levels broken. Sentiment indicators reached extremes, suggesting maximum pessimism. Yet the actual metal, the physical commodity those futures contracts theoretically represent, was being accumulated aggressively. This created an arbitrage that shouldn't persist in efficient markets. If paper silver was truly oversupplied, arbitrageurs should drain physical inventory to deliver against short futures positions, taking advantage of the premium spread and equalizing the two markets. But that equalization wasn't happening. Because the entities accumulating physical metal weren't interested in short-term arbitrage, they were interested in long-term positioning. The industrial demand picture reinforced this dynamic. Solar panel manufacturers, now consuming roughly 100 million ounces of silver annually, didn't reduce orders because futures prices fell. Their procurement operates on contract schedules and production requirements that don't fluctuate with daily price movements. Electrical vehicle production, another significant silver consumption category, continued its expansion trajectory regardless of precious metals volatility. And the broader electrification trend driving structural silver demand showed no signs of policy reversal or technological substitution. In other words, the fundamental consumption of silver as an industrial commodity remained intact, while the financial representation of silver as a tradable instrument experienced crisis. Then there's the inventory reality that most analysis completely overlooks. COMEX warehouses. The primary delivery mechanism for futures contracts in North America showed a peculiar pattern. Registered inventory, metal explicitly available for delivery against contracts, remained relatively stable despite the price collapse. But eligible inventory, metal stored in COMEX facilities, but not designated for delivery, showed subtle but significant outflows. What this suggests is that metal owners weren't panicking. They were reallocating, moving metal out of the exchange system, into private storage, or into jurisdictions where physical possession carried less counterparty risk. The London vaulting data told a similar story. Total silver holdings in London. Bullion Market Association facilities didn't show the dramatic declines one would expect if the bull thesis had genuinely broken. Instead, the pattern resembled consolidation. Metal moving from weaker hands into stronger hands, from leveraged positions into unleveraged positions, from speculative holders into strategic holders. ETF flows added another layer of complexity. Some silver ETFs experienced redemptions during the volatility. Investors exiting positions as prices fell, standard panic behavior in leveraged financial instruments. But other ETFs, particularly those with physical backing and delivery mechanisms, showed inflows or maintained stable holdings despite market chaos. The interpretation couldn't be clearer. Capital was differentiating between silver exposure and silver ownership, between price speculation and asset accumulation, and the divergence between those two approaches was creating the exact premium expansion visible in dealer markets. Here's what this means in strategic terms. If you're a short-term trader using leverage in futures markets, February 2025 was catastrophic. Positions liquidated at losses, margin destroyed, capital preservation impossible in the velocity of the decline. But if you're an entity measuring value and supply-demand fundamentals over multi-year horizons, if you're accumulating physical metal for industrial use, monetary diversification, or strategic reserve building, then February 2025 was precisely the opposite. It was dislocation creating opportunity, paper market panic creating physical market access, and temporary price volatility creating entry points that fundamental analysis suggested wouldn't last. This is what the term physical takeover actually means. Not some coordinated scheme or market corner, but a gradual systematic transfer of actual metal from financial market participants into the hands of end users and long-term holders. A transfer accelerated by volatility events that shake out weak positions while strengthening conviction among those who understand the underlying scarcity. And that scarcity, that fundamental imbalance between annual production and total demand, hadn't changed. Silver mine output faces declining ore grades, increasing extraction costs, and long lead times for new production capacity, none of which gets resolved by futures market sell-offs. So while screens showed collapse, the physical market was quietly demonstrating something else, that price and value had temporarily diverged, and that divergence was creating precisely the conditions for the next phase, whatever that phase might be. The question that matters isn't whether silver experienced a violent correction. The question is whether the fundamental conditions that created the bull market in the first place have changed, because corrections happen inside bull markets, collapses happen when the underlying thesis breaks, and the evidence from February 2025 suggests something crucial. The thesis didn't break. The price structure did. There's a distinction here that separates strategic thinking from reactive panic. Strategic analysis asks whether the forces driving long-term value have altered. Reactive panic asks whether recent price action hurt. One of these questions leads to informed positioning. The other leads to capital destruction. So let's examine the structural case dispassionately, starting with the monetary environment that created precious metals demand in the first place. Global sovereign debt hasn't declined. It's accelerated. The United States alone carries debt levels that would have been considered catastrophic 2 decades ago, yet now represent the new baseline from which further expansion occurs. European economies face similar trajectories with even less fiscal flexibility, and emerging markets navigate currency stability challenges that make hard asset allocation not optional, but necessary. Central banks globally face an impossible constraint: inflation rates that demand monetary tightening versus debt service costs that make sustained tightening economically destructive. This creates a policy environment where real interest rates, nominal rates minus inflation, remain suppressed regardless of headline rate adjustments, and suppressed real rates have historically represented the most favorable environment for precious metals appreciation. Not because metals generate yield, but because they don't lose purchasing power while yielding instruments do. The February sell-off didn't alter this dynamic. It occurred within it. Fiscal trajectories haven't reversed. Monetary constraints haven't disappeared. Currency debasement pressures haven't resolved. The macro conditions supporting hard asset allocation remain structurally intact. Now layer in the supply-demand fundamentals specific to silver. This isn't abstract monetary theory. This is physical commodity mathematics. Annual silver mine production globally sits around 800 million ounces. Total demand, combining industrial consumption, investment demand, and jewelry fabrication, exceeds 1 billion ounces. That's a structural deficit of roughly 200 million ounces annually, filled partially by recycling and partially by drawing down existing inventories. The critical question becomes, is that deficit temporary or persistent? Industrial consumption trends suggest persistence. Solar photovoltaic production continues exponential growth trajectory. Each gigawatt of solar capacity requires approximately 1 million ounces of silver. Global solar installation targets for the next decade imply silver consumption increases measuring in hundreds of millions of ounces, with no commercially viable substitute material achieving the same efficiency at comparable cost. Electrical vehicle manufacturing adds another demand vector. Average silver content per vehicle ranges from 25 to 50 grams depending on vehicle type and electrical architecture. As EV production scales from millions to tens of millions of units annually, that translates to measurable incremental silver demand that didn't exist a decade ago. The broader electrification trend, grid infrastructure upgrades, charging networks, renewable energy integration, all carry silver intensity, all represent structural demand growth independent of precious metals. Investment sentiment. On the supply side, the constraints are equally structural. Primary silver mines face declining ore grades across major producing regions. Mexico, Peru, China, the dominant production sources, all report increasing extraction costs and geological challenges. New mine development timelines extend across years even after discovery. Permitting, construction, ramp up to full production. None of this happens quickly, which means even if silver prices incentivize new production, there's a multi-year lag before that production actually reaches market, during which existing deficits persist and potentially expand. This supply-demand imbalance doesn't care about futures market volatility. It doesn't respond to leveraged position liquidations. It's a physical reality that compounds annually regardless of short-term price action. Now address the volatility itself, because this is where most analysis fails, treating volatility as evidence of market failure rather than market characteristic. Historical precious metals, bull markets, have always included violent corrections. The 1970s gold and silver bull market experienced multiple drawdowns exceeding 30%, before ultimately delivering returns, measuring in multiples. The 2000s commodity supercycle saw corrections that convinced participants the trend had ended, only to resume with even greater force. High volatility in precious metals during bull phases isn't aberration, it's signature. These markets are relatively small in total value compared to equity or fixed income markets. They're susceptible to speculative positioning extremes. They lack the continuous liquidity of larger asset classes, and they attract leverage that amplifies both directions of price movement. Which means violent sell-offs can occur within intact bull markets. Not as contradiction, but as feature. The differentiating factor between correction and collapse lies in what happens after the violence. Do fundamental buyers step in? Does physical demand persist? Do the structural drivers remain operative? February 2025 demonstrated affirmative answers to all three questions. The premium expansion in physical markets confirmed fundamental buying. The industrial demand continuity confirmed consumption persistence, and the unchanged macro conditions confirmed structural driver integrity. Here's the framework for a strategic assessment. If you're evaluating silver as a trading instrument for short-term speculation, then volatility represents terminal risk. Leverage becomes unsurvivable, and preservation requires exit regardless of fundamental view. But if you're evaluating silver as a strategic position within a longer-term portfolio framework, then volatility represents noise, fundamental imbalances represent signal, and temporary price dislocations represent opportunity rather than threat. The entities accumulating physical metal during the sell-off understood this distinction. They weren't reacting to what futures markets did yesterday. They were positioning for what supply-demand fundamentals will do over the next decade. The case for silver's bull market persistence doesn't rest on denying the violence of the correction. It rests on understanding that correction occurred within a larger structural context that remains unchanged. Monetary instability persists. Supply constraints persist. Demand growth persists. And the gap between paper market pricing and physical market reality, if anything, widened, which suggests the next phase won't be characterized by stability. It will be characterized by continued volatility, with a directional bias determined not by futures market sentiment, but by the relentless mathematics of structural deficit meeting persistent demand. For decision makers navigating this environment, the question isn't whether to fear volatility. The question is whether to understand it, and whether to recognize that in markets driven by fundamental imbalances, violent price action often represents transition, not termination. The bull persists. not because the sell-off didn't happen, but because the reasons it started never stopped.